Today's note will self-destruct in roughly 2 hours. And then again, and likely again. That's because House Republican leaders now, finally, have released the first draft of a tax code overhaul they've spent months developing behind closed doors. But the process kicks off a rolling analysis of the measure's impact, as interest groups of every size and stripe race to assess how they make out. The last few days suggest the project remains in what could charitably be described as rough shape. Scrambling to find sources of revenue to pay for a sprawling, $5 trillion wish list of tax cuts, GOP tax writers on Wednesday also appear to be scaling back their ambitions, both on the individual and corporate side of the code. Here's what we can say at this point: the successful pushback against efforts to kill the state and income tax deduction, as well as lobbying to kill pre-contribution taxing of 401k retirement contributions, has established a playbook for every industry group or business that combs through the forthcoming text and decides they'd be better off under the status quo. Simply cobble together a couple dozen of the most like-minded Republicans and convince them to threaten to bolt if leaders don't drop the offending provision. The struggle to make the math work had GOP tax writers toying as late as Wednesday with the possibility of abandoning a central aim of the project by chopping the corporate tax rate from 35% to 20% only on a temporary basis. The plan that House Republicans rolled out today, however, calls for making that change permanent. Among its other core changes, for a quick first take from my colleagues Mike DeBonis and Damian Paletta, it will create giant new benefits for the wealthy by cutting business taxes, eliminating the estate tax, and ending the alternative minimum tax. The legislation would cut in half the popular mortgage interest deduction used by millions of American homeowners, changing the deduction's rules for new mortgages. Presently, Americans can deduct interest payments made on their first $1 million worth of home loans. Under the bill, for new mortgages, they would only be able to deduct interest payments made on their first $500,000 worth of home loans. This change could have a particularly big impact on high-cost areas, such as San Francisco, New York, Boston, and the Washington, D.C. area, and housing groups and lawmakers will likely try to defeat it. The bill would allow people to deduct their local property taxes from their taxable income, though this benefit would be capped at $10,000. The bill would nearly double the amount of money not subject to federal income tax, a tax break known as a standard deduction. Under the plan, that deduction would rise from $12,700 per family to $24,000. But this benefit would be partially offset by the personal exemption many Americans could claim, which can be large for families with multiple children. The bill's true impact on the middle class will be difficult to immediately measure. The bill would create a new family credit and expand the child tax credit used by working families. The child tax credit would grow from $1,000 per child to $1,600 for each child. Republicans on the Ways and Means panel, for their part, broadcast cheeriness about the imminent launch of the package as they filed out of a Wednesday night meeting that stretched for over 3 hours as they reviewed the fine print. "We're doing great, on schedule for the morning and excited," Brady said. "We'll continue to listen. We're going to make improvements at every step. We're going very bold, so we expect people and families and businesses to respond and tell us what they think." But the last-minute chaos of getting the bill together has spilled over into proposed changes to the individual side of the tax code, as well. Republican leaders were still struggling Wednesday to forge a compromise with their rank-and-file from high-tax states like New Jersey and New York, a cohort threatening to oppose the package because it proposes to eliminate the federal deduction for state and local taxes, otherwise known as the SALT deduction. More from Damian and Mike. Several members said Wednesday that Republicans were looking at capping the property tax deduction at around $10,000, though discussions remain fluid. Still, several members said the changes weren't sufficient. If enough Republicans refuse to accept the adjustment, they could oppose the bill and potentially kill it on the House floor. And the AP reports that Republicans are likewise backing off plans to wring out some new funding for their proposal by limiting tax-free contributions to retirement plans, including 401ks, after the idea met resistance both from President Trump and some of their own in the chamber. Furthermore, following what can only be termed as unhelpful pre-rollout tweets from President Trump, Republicans are considering including the elimination of the individual mandate to buy health care, though the language isn't expected to be in today's draft. Damian and Mike, Again, 3 Republican members of the Ways and Means Committee and a GOP leadership aide, speaking on the condition of anonymity to describe internal deliberations, said that there has been serious discussion about including the individual mandate repeal in the tax bill. But they said that the committee is divided on the issue and that it is unlikely to be included in the initial draft. Republican leaders have held their plans close in part to forestall that bloodletting. Even still, the process wasn't airtight, and the National Association of Home Builders and the National Association of Realtors both are already putting their considerable muscle behind opposition campaigns. Untold others will begin laying plans to join them in the hours ahead. Buckle up! And President Trump, as always, is a wild card that could upend the negotiations at any moment.